Great. So, welcome you all to today's section. Today, we are going to look at the interpretation of financial statements. So, we are going to look at the interpretation of financial statements. Great. Financial statements. That's today's section. Now, the financial statement prepared by the company, it must be interpreted and provided meaning to it. So we have to provide meaning to the financial statement prepared so that other users can make meaningful decision out of it. Great. So basically, that is the interpretation of financial statement. Meaning we are going to provide the actual meaning, or we are going to analyze the I'm going to analyze the performance of the entity. So the main target is the performance. We are going to explain the performance of the entity. Wow, that is it. That's an underlying word, the performance of the entity. That is the interpretation of financial statements. Great. You know, when the terminal results of the kits are being sent to us, uh, if the grading system of that child is not known to you, then you need assistance. You have to call someone who can interpret that results to you. So the same way, some of the owners of the company, some of the users, some of the investors, they don't have enough knowledge or experience to provide the actual performance of the entity. So for that matter, they have to fall on what resource personnel, such as financial analysts and then consultants. So today we are financial consultants, yes. For today we are consultants. We're going to explain the or analyze performance of company. That is all about interpretation of financial statements. You explaining the actual meaning of the financial statement presented to you. You can also interpret your own financial statement, set of financial statements. That is it. So let's see. Now, there are so many tools that we use to explain the performance of the entity. So many tools that we use. You're going to look at them one after the other. Great. So the tools are, so let's call it methods of providing the analysis or the tools. So the tools that we are going to use or the methods to analyze the performance of a particular company. What are the tools or the methods that we have to use? Basically, there are three common methods that we will use. So first, method number one, we call it the common size. Common size or vertical analysis. Yeah. Vertical analysis. Good. So vertical analysis. That is the vertical analysis. Then two, we have what we call trend analysis. Trend analysis, or we will call it horizontal analysis. So we call it horizontal or trend analysis. So good. Horizontal or trend analysis. Then finally, almighty, using ratio analysis. Ratio analysis. So these are the three methods or three tools that will help us to analyze the performance of the company. The most common one is the ratio. So that is why most often we refer to this topic as what ratio analysis. But the actual meaning is the interpretation of financial statements. Now to start with the common size or vertical analysis. Here, as the name suggests, common, we are just going to calculate percentages or strike averages on a very common figure, prone to all of them. Good. So with the common size, we just have to look for a common figure for the profit and loss and the financial position. Then we express all the items in the financial statement as a percentage of that item or the common base. Good. Now, to do the ratio analysis, sometimes the knowledge of the financial statement preparation will still be needed here. So here too, the examiner assumes that when it comes to financial statement preparation, you are superb, right? Good, especially the profit and loss. Good. That is it. So common size, simple means we are going to express all the items in the financial statement as a percentage of a common base. A common base. So if we take your profit or loss, what is the common item there? Profit or loss, there must be a common item. So that from sales revenue up to what? Profits after tax. We are going to express all the items over there as a percentage of a common base. That is the common size. So sales, cost of sales, gross profit, down up to anti-parts. That is the profit after tax. We are going to express all of them as a percentage of common base. Now, for profit and loss, the common item is what? Is the sales. So the common base is what? Sales to revenue or your revenue. So sales to revenue will be the common base. So you pick all the items in the profit or loss, then you divide it by the sales figure, you multiply by 100. That is the common size analysis. Great. So basically, that is how we are going to cap. Then when you go to that of the financial position, the balance sheet, the common base is the total asset. So that one too, you pick all the item and divide it by the common base. Good. You pick all the item and the common base over here is the total asset. Total assets. That is the common base. So basically, you pick all the items in the profit or loss, divide it by sales, and multiply by what? 100. Good. For all of them. So this is how we calculate the common size ratio or the common size. We'll do the calculation for today. Then we will start with the reports when we are done with all the calculation. Yes. Okay. So let's cite an example. Let's cite an example and let's see how we can strike the common size this financial statement. So if I prepare financial statement like this, financial statement like this. So the company name is June July Limited. So June July Limited. Yeah, that's the name of the company, June July Limited. Now this is the profit or loss account. So this is a statement of the profit or loss account. So statement of profit or loss account. This is it. And this is June July statement of financial position. So statement of financial position of who? June July. Great. Now the common base for profit and loss has been determined already. So any question they give it to you and you are to conduct common size analysis, if it's on statement of profit or loss, the common base has been determined what already, which is what? Sales revenue. So you have to look for the sales revenue in that question. That's the common size. Or their gross receipts. If it is, let's say school will not sell. So probably you see something like uh tuitions, fees. Good. That is it. So that's the common side. So you have to know. So let's see all the statements. So if you pick statement like P&L, profit and loss, the common side is what? Sales. So let's remind ourselves. Financial position or the balance sheet, the common side is what? Total assets. What about changes in equity? We said that the changes in equity, that one, all the items there relate to financial position. So we assume the financial position, except the profit after tax. The profit after tax, that one relate to profit or loss. So all the items in the change in equity will still reflect in the financial position. So they belong to financial position. Then cash flow if you are to perform common size analysis on cash flow, that one, the common size is what? Total inflow, all the inflows or the outflows. Select one. We are done. Great. So these are the common items. So common size simple means express all the items in that particular financial statement as a percentage of a common base. Agreed. As a percentage of what? A common base. Good. Then we are done. Now let's see. Let's go back to our question though. Now let's say the question together. This is June, July Limited. June, July Limited. This is the financial statement for one of it recent year. So 31st December 2019 or 30th September 2020. Okay, so the sales revenue reported in thousands of cities. Sales revenue, we had 60,000 cities. Wow, so that's 60 million. The cost of sales happened to be 25,000 cities. Wow, he did well. So the profit, which is direct, happened to be 35,000. That is the gross profit. Gross profit. Now let us assume that the operating costs happen to be 15,000. That is the operating cost. So June, July's operating profits happen to be, but I'll do something here. It's still 15,000, right? Okay. Good. We are setting our own question. Then we have profit on disposal. On disposal. Then happen to be 2,000. Then we have finance cost. Finance cost also happen to be, we are subtracting the operating cost. So that's 2018. Finance cost happen to be 5,000. 5,000. So you take it off. So what's the profit before tax? Profit before tax. Before tax. And then almighty tax. In fact, let me bring everything so that I'll get profit after tax rate for it. I don't want trouble. So income tax expense. Income tax happen to be 6,000 cities. 6,000 cities. So therefore, profit after tax, that's antipart, happen to be all this. So together, that's 7,000 there. Good. You can confirm for me if it's 7,000. Okay. Sorry. Good. And let's go to the financial position. PPE, non-current assets. PPE just Ghana city of 100,000. Wow. Current asset is also 80,000, giving a total asset of what? 180,000. Then we break down. Then equity. Equity happen to be everything on an equity. Let's assume that it's 100,000. Liabilities, all liabilities is also 80,000. So that's also balanced nice. Very straightforward like this. And you've been asked to provide a common size analysis. So this one is the question. June, July limited. June, July limited. So if you are going to provide a common size analysis, you strike your percentage. So you create additional column. So let's create it here. So something like this. So tell the examiner the percentage. So here is a percentage of sales. So what's the common item here? The answer is 11,000, not 7. Okay. Okay. 11,000. Now with the common size, just look for your sales and express all the items here as a percentage of the sales. That's for profit or loss. So let's see. So for the sales, it will give you 100%. Yes, because that's the base. How do you get it? It will be 60,000 like this, divided by 60 times 100. So that will be 60. So if you move on to the next item, which is the cost of sales, the figure is 25,000 cedis. Now I just have to change it. Pick that one, divide it by sales. I put it there. Come here, divide it by sales. So everything divided by sales, everything on sales. So here is 35,000 divided by sales times 100. That is the common size for June, July. June, July. So 35 divided by 60 times 100. That's 58.3%. So 58.3%. Okay. Now, if we take this from this, what do you get? But it seems like I have jump one. I use the 35. So 35 will be for what? That's the gross profit. So 38.3%. Now let me make here 25. That's the cost of sales. Agreed. So if you start all over again, everything started afresh. So that just pick whatever you are looking for. I'm looking for cost of sale, which is 25 divided by 60 multiplied by 100. So it will be 25,000 all divided by 60,000 times 100. And that'll give us, so 41.7%. So 41.7%. Then here to give us 41.7%. So 41.7%. So that is it. Then you put it in. Then you come to gross profit. It's 35, right? Easily, you can take this one from this to give you the same answer, or just strike 35,000 out of 60,000 times 100, and that will give us. So that was the 58.3%. So that will give us 58.3%. So this game, you continue until you are done with the calculation. That is the common size analysis. For that of operating cost is 15,000. I just have to change the top to be 15,000. So go again. So if it's 15 divided by 60 times 100, that's 25%. So here will be 25%. Then you continue till you are done. So you find the percentage up to the profit after tax. Great. So you will continue that one. Now let's push to the financial position. For now, we are just learning how to strike the percentages. If we're okay with it, we write a nice report about that. The report writing will come later. Good. Then we go to statement of financial position. That one to the common size, we said is the total assets. So quickly locate your total assets. The total asset here is 180, right? Good. So you pick all the amount here, every item divided by the total assets, and then you multiply by 100. So PP, which is 100,000. So PP will be 100,000 all divided by 180 times what? 100. Good. And that will give us something like as 10 out of 18. Okay, so we can state that. So sorry. Great. So we can state that it's 55.6, right? Good. So 55.6%. What about the current asset, which is also 80? I just have to change the top to what? 80,000 divided by the total assets times the 100. That will be 80 by 180. That will give us 4444444. So we can tell the examiner that it is 44.4%. If you add the two together, it must give you 100. Or if you take 180 out of 180, that will give us 100%. Good, in that order. So it continues. This one is considered that the PP is equal to the equity, those stuff. And here in a real exam scenario, we will give you the breakdown of the current asset, equity, everything, the breakdown. Yes, like I said, examiner is very much aware that when it comes to financial statement preparation, we spent 1 month there, so you are superb. So you do that. So that's the common size. We are going to use this. Now, if you realize that most of the expenses here to the sales ratio are high, then that performance of the performance of that company is a bit low or below average, or suggests that the company is unable to control its costs. Yes, given high level of cost as compared to your sales. So if you check this company, your cost of sales represent 41.7%. Wow. Cost of sales represent 41.7%. And then operating costs represent what, 25%. So the cost of sales here to sales ratio is higher than that of the operating cost to sales ratio. This suggests that this entity does not control its production cost effectively. So efficient control production costs can lead to this scenario. That is it. So let's move on. After everything, we will write a full report on how to analyze the performance of a company. Now we are just at the intro level. So that's the end of the common size. We will look at it fully at the report section. Good. Now let's move on to the trend analysis, because there are three sections. Now another name for the common size is also called vertical. Have you seen the structure? Vertical, like straight down. That is the reason for its second name, called vertical analysis. So either common size or vertical analysis. You are free to go. You are free to go. Okay. Now let's move on to the second tool or second method in which we can use to analyze the performance of a particular company. We call it what? Horizontal or trend analysis. That's the method 2. Horizontal or trend analysis. Horizontal or trend analysis. Good. So we are on the horizontal or trend analysis. That is where we are now. As the name suggests, horizontal analysis. Here, you compare the company's performance over time to obtain trend. So we are going to compare the performance of the company over time, meaning several years. Several years, bracket several years. Several years to obtain trend. To obtain what? Trend. So that's why we call it horizontal or vertical analysis. Basically, Let's take June, July. So if you pick June, July financial statement, June, July limited. So if this is the profit or loss, the P&L, so we will have P&L for, let's say, the most recent year, 20, so 2019, 2018, 2017. Good. So if you tell you sales, there was 75,000. The 60,000 that you saw there was the sales. Last year was 55,000. And this section happened to be 60,000, 75,000. All up to profit after tax. A well prepared financial statement will be available to you. So, therefore, the trend is that we are just going to look at the changes in these figures. That's all about horizontal. Have you seen that one? The analysis look like this. So it goes straight like that. So that's why you call it what? Horizontal analysis. So you compare from 2017 to 2018, look at the trend. Compare 2018 to 2019 and then the trend. It can be 5 years, 2 years, 3 years, 10 years, 15 years, and more. So that's all. So yeah, let's see if we can tackle the change in what? Sales. So if I should calculate the change in sales, so change. So let's see. We cannot get for that of 2017 unless you have 2016 there. So 2018 will be changes. So the new minus the old, all divided by what? Old. So this one is 75,000. So here you can see a drop of what? 20,000. So 55 minus 75, which is 20,000, all divided by the old, that is 75. That will give us what? The change. Change simple means the increase or the decrease in the figures. So basically, that is it. Okay. So here, what will be the percentage change? So realize that from 2017 to 2018, sales dropped from 75 up to 55,000, which represents so it dropped from 75,000 up to where? 55,000, which represent what percent? So we find a difference. That will be it dropped by 20,000, right? All divided by the old. The old is still 75 times 100. That's 26.7%. 26.7 what percent. So that's the drop. So you can put it in brackets, negative, meaning that, or you can put small negative here. That means it represents what? A negative change. It dropped from 75 up to what? 55, representing 26.7%. How do you get a 26.7%? It is the new, which is 55,000, minus the old, 75,000, all divided by old, 75,000, times 100. So this is how we arrive at the 26.7%. So what about 2019? Who can tell me whether has been increased or decreased or percentage change? So changes, that's percentage change in the figures. So in 2019, the sales figure increased by what? 9.1%. Great. So this is what you mean by what? Trend analysis. You do the same thing for all the items in the financial statement. So both for profit and loss, changes in equity, financial position, cash flow, the same thing. Percentage change. We are done with the trend analysis. Now let's move on to the common one or the widely used method to provide the analysis. Good. So the most widely used approach or the tool is the ratio analysis. Good. So let's see ratio analysis is the widely used method, common one. Good. So as a result of that, if you mention ratio analysis or interpretation of financial statement, what comes to mind is the ratio. Good. So let's see ratio analysis. Using ratio analysis. Using ratio analysis. Now, using ratio analysis, we are going to provide the meaning of the actual meaning to the financial statement prepared. Now, what's the meaning of ratio? Basic mathematics. Ratio. Hmm. Don't mind further. Ratio simple means dividing number by number or dividing something by something or expressing something as a relationship of other item. That's the basic meaning of ratio. So elementary, coffee age, the ratio of coffee's age to Ahmed's age. How are you going to express that? So ratio of what? Coffee's age to Ahmed's age. So that would be coffee over Ahmad. Having that is the ratio. Basically, that is it. Now, in interpretation of financial statements, we have meaning to all our ratios. Good. So let's see. Now with these ratios, we are going to pick certain figures in the financial statement, look at its counterpart and divide it by it and use it to analyze the performance of the company. So that's the ratio analysis. In the context of what? Interpretation of financial statement. We will pick certain figures in the financial statement, divide it by each other, then it will tell us, it will reveal some secrets about the company, and then we are done. So basically, that is it. Now, when you mention ratio analysis, it has few importance or the advantages of the ratio analysis. So let's see. So advantages of ratio analysis. Advantages of ratio analysis. I'll give you few, not many, just little of the many advantages. So you can use the other section to analyze the rest for me. Good. Great. So with the help of ratio, we can analyze the performance of companies. So ratio help us to analyze what performance of company. So advantages Number one, help us to what? Analyze the performance company. Two, ratio help us to assess the profitability level of an organization. So help us to assess the profitability level. Okay, so with the help of ratio, we can make a clear decision which of these company is profitable or which of the company is doing well in terms of profitability. Okay. Then you can also use profitability to assess the liquidity position or the liquidity stand of a company. So the liquidity position and the liquidity stand of a company. Good. So liquidity, you can tell this company will be able to pay all its short-term debt as and when before due or as and when they become crystallized or become payable. That is liquidity. You know, some of the company they are very big in terms of size. When it comes to liquidity, they are small babies. With the help of ratio, can be able to do that. Good. Then four, ratio help us to assess two types of risks. I will separate them by all the assess risks. The first type of risk that the ratio analysis assess is called operational risks or the operational efficiency. So operational efficiency slash what risks, operational risks. Oh yes. Ratio help us to assess that. Good. When we start the actual ratios, you will know which of the ratios will help us to assess the organization's operational efficiency. How efficient the organization utilize its assets at its disposal to generate enough cash or revenue. So you see, some of the organization they are too big. But if you look at their revenue, say, this one, if these two by four companies sit at home and put their performance together, they can do better than this big company. So that means there's operational risks or there's operational inefficiency. Like someone that have uh, a bus which can contain, let's say, 50 passengers and a taxi driver. And then the taxi driver can make sales of, let's say, 1,000 Ghana, let's say, 1,000 cedis a week. Meanwhile, it contain only maximum of four passengers at a time. You, the driver, that you have 50 people at the time. Your sales your sales is just around 4,000. The sales is just around 4,000. So realize that it does not equate. It does not equate at all. So that is the operational efficiency. Okay, great. Now, the performance is a general view. The performance we are talking about here is a general view. Good. Profitability and liquidity are two different things altogether, even though all of them box onto profitability. The issue is this. Some organizations, they can have profits or they can earn well. They know how to utilize their asset to generate enough revenue, give them a lot of profit. But when it comes to cash generating, not at all. Not. They can show a big profit, ask them their cash. Phew, that guy might suffer from what? Liquidity. But it's very good in terms of profitability. So the profitability look at the operating section. So you can say profitability or operating performance. This one is also called operating performance. That is it. And then the liquidity look at your ability to generate cash. Some organizations too, they are very good in terms of collecting cash or generating cash. Oh, wait, they have a positive cash flow balance. When it comes to cash, don't go there. But when it comes to profit, no, not. You cannot have all the two. No, you have to sacrifice one. So tell me the one that you like. Do you like profit or you like cash? You can't get all the two. Big. No, you have to sacrifice one. Because if you try to sell your goods on credit, a lot of people buy, right? But will they pay you? Not at all. So sometimes some of them run away the money. So you show a big profit, but the cash will be what? Too small. Great. And then if you said, okay, me, I'll not sell on credit. Everything must be cash and carry. Yes, you get huge cash, but it will deter many people from buying from you, right? So you lose a lot of customers, a lot of sales. So your profit will also be what? Too little. So tell me the one that you think is very good for a business organization, or they should have both. You can't have high cash, high profit. That one, no, you can't do that. Yeah, so tell me the one that you are going to sacrifice for. You need cash, so you forget about profit. Or you want profit, forget about cash. Good. So that is it. And then all of them box onto the performance of the organization. This performance is general view, general, or material respect. Good. Now let's continue the game. I hope your question been answered. Good. Now the fifth advantage will be the second risk, financial risk. Ratio help us to assess the financial risk of the organization. What is the meaning of financial risk? Financial risk simple mean risks associated with what? Debt. So if anyone or any company have long-term debts among its capital structure or the capital employed, you will face a particular type of risk called financial risk. Example include what? Default risk or bankruptcy risk. That is the examples of financial risks. Risks that associated with what? Debt. Ratio will help us to analyze which company is closer to its liquidation, or which company have more risks or exposed to financial risks. Okay. So basically, that is the few advantages of the ratio analysis. The first one is upon all these, they use it to make decisions. So for decision making. Today we are financial analysts or financial consultants, all of us. So June, July, if an investor have approached you that you want to invest all his last money, it being pension money or all the lifetime savings in a particular company, hoping that you get some later return and then turn it around. So you run to your aid. If you inform you that you are financial analyst, or when it comes to financial performance review, you are superb. So you have asked for your opinion. Before you can advise that investor to come and invest his funds since June, July, you have to perform some sort of calculation ratio to analyze the performance of what the company, right? Good. To determine whether it's safe to invest in June, July company. That is the for decision making. Good. That is ratio analysis. Okay. Now, I'll go straight and move on, but there's one factor. I'll chip that one in. If I chip it in here, we might not understand it in detail. That's the disadvantage or limitations of ratio analysis. It's very important. So I'll look at that one after some few calculations so that you bear witness of some of the disadvantage. Then I'll give you a few of them. The remaining one will be reviewed at the end of the section. You should know at least 5 solid advantages, 5 solid limitation of ratio analysis. Oh yes, ratio have what? Challenge limitation. Yes. Okay. Now ratio analysis. The main challenge is that ratio on their own, they are meaningless unless being compared to other ratios. So that's the first challenge or the limitation of the ratio analysis. The limitation of the ratio analysis. On their own, they are what? Meaninless unless being compared to other ratios. Of course, if you calculate a particular ratio and you get, let's take ROCE for instance, return on capital employed. Yes, you get it. You calculate and get 20%, and so it does not tell the actual performance of the entity. Even if you get 30%, it does not reveal. If you get 25, it does not reveal the actual performance, whether the performance been increased over the period or decreased. Unless you compare it with other ratios. So if ROCE for the current year and previous year, current year is, let's say, 30%, previous year is 20. Oh yes, that's what increased. So they've done well. Now the performance has been what? Improved. For instance, a critical example is like this. If you bring the results home kids bring results home and they said, okay, he scored 65 in, let's say, mathematics exam. Good. He scored 65% in mathematics exam. How do you know if he has performed well? First, you ask, okay, what's the pass mark? Okay, let's say 50%. So you compare it with the past mark. Or second, ask, okay, how many people wrote that paper? Were you first or second or third? Or you have to compare this. So this is first person compared to the other person's mark and see out of the two children who scored the best result or which of the two performance is good. So if you look at just one, it won't tell you the actual performance. So that's why there's a proverb that goes like this. If I've not gone to someone's kitchen before, don't stay at your corner and say that you are the good what cuckoo. Or if I've not gone to someone's farm before, don't say that you are the best farmer, right? Good. So unless you compare to the other ones before you can determine what the best one. So that's ratio. It comes to ratio. So the main challenge is that unless you compare it with the other ratios. So we are looking at the limitations. One, we said that on their own is meaningless. So meaningless. Okay. Then let's see the next section. Now, the challenge that we have, or another challenge that we have with the ratio is that these ratios, if the accounts are manipulated, that means the ratios to are also what? Manipulated. Good. So if the accounts have been manipulated, all the decisions out of such account or the performance too will also be faulty. So you say that it is limited to what? Accounting manipulations. Good. That is the second point. So if you pick a wrong account, you feel like you are making the best interpretation ever. It's so wrong. Oh. Yes, it's so wrong. Because they are the accountant will mislead you. Yes, with certain information. Good. So that these profits they've done well. In fact, the net profit margin is too huge. The profit in this year. Meanwhile, it was the revaluation gain in which the accountant did not treat it well, and he intentionally added to the other income, which increased the profit after tax. So it was just a notional other comprehensive income, which is not a, a real profit. And you are saying, oh, they've done well. Come and put all your lifetime savings there. You put it there, the next day they are not paying dividend, the next day they don't exist, and then it become an issue. That's why the interpretation we have to be careful in reality, not exams. If your exam questions are not manipulated, no. The exam questions they are not manipulated. In reality, the exam questions are not manipulated. So that is it. So manipulations can render our account invalid. Then three, we can talk about is limited to changes or selection of different accounting policy. So limited to changes in accounting policy. Changes or selection of different accounting policy. Different accounting policy. Okay. So let's assume that you are comparing your own performance for, let's say, 2018 against 2017. You, in 2017, your accounting policy is different from that of 2018. It will not give you, or it will not reflect the actual performance of the entity. If you want to compare, or if you want to compare and then to obtain the actual performance, then they must be of the same what base. The same policy, the same policy. How we get it? That is for if you are comparing your own results. What if you are comparing two companies, company A and company B? Just that company A selected different accounting policy from that of company B. That one too, whatever you conclude to is limited because you have different base. So that is it. Then let's continue the game. Now, if ratio analysis does not reveal the actual performance of the entity, actual performance, let me put it here. That's the fourth one. It does not reveal what? The actual performance. So number four, it does not reveal the actual performance. So actual performance is not revealed. So it does not reveal what? The actual performance. Let's cite an example. 2019, you performed very well. And a financial statement, let us prepare it at December. They audited it, everything. It was ready in March, 31st March 2020. They signed everything. So you pick it around June 2020 and we're doing performance review. And then you were so happy, clapping for yourself. Why? Because in 2020, your sales alone was 300 million Ghana cedis. And your profit after tax, key highlight, was around 150 million Ghana cedis. So you are so happy. You are doing this performance review when? 2020 July. In fact, you did it through Zoom, virtual. Now 2020, if 2019 you perform well, doesn't mean that 2020 when you are doing the review, the company's performance is still the same as that of 2019. Not at all. Take 2019 and 2020 for example, COVID time. So doesn't mean that the good performance is the same as what we are seeing here. No. This is as a result of we always use what we call past information. So it will not provide a reliable guide in future. You can make a profit in 2019. That was not in 2022. In fact, you are even making profit. Look at COVID. Destroy everything. Change things. Turn everything upside down. The same way in 2020, the performance will be very terrible, very bad. Then you in 2021, let's assume that COVID vanished at the end of 2020. So you're doing performance review in 2021. Because here you made a loss of 200 million Ghana cedis. A loss of 200 million Ghana cedis in 2020. Does it mean in 2021 you make such loss? Not at all. So it tells you that the analysis that we are going to do is not the actual, it's past, it's for previous year. And that does not mean that it's still the same currently, because transaction events can change. So that is it. Great. And then the last one that I'll state is this. It failed to consider the non-financial aspects of the organization. It does not consider what? Non-financial aspects of the organization. Non-financial aspects. What are you interpreting? You are interpreting financial statement. Wow. Financial statement, FS. So anything that is not in the financial statement, you're not going to talk about it. But the non-financial aspect of the organization are very crucial. Any company that wants to survive in the long run have to work on the non-financial. Examples of non-financial include: one, product quality. Good customer relationship or customer service. Employee morale. Good public image. Non-financial aspect of the organization or non-financial information. Good. An example include what? Good public image, product quality, expertise of labor force. All of these are non-financial statements. Is it the P&L or the balance sheet? If recorded that my employees are skillful by 20,000 Ghana cedis. No. My product is quality by 45,000 cedis. No. All this will not appear on the financial statement. We are interpreting financial statement. So if you depend solely on the financials, no. No. You are not making a complete analysis. So the ratio that we are going to calculate is purely financial ratios. So the challenge is that we have left out the key aspect, which is the non-financial section, which will render our decisions what? Invalid. So it's limited. For decision making, the financial statement alone is what? Is limited. For decision making purpose, financial statement alone is what? Limited. You need other information. In fact, some company, you are not investing there because of their money. You are investing there because how they treat their employees. You are investing there because their products are very good. You are investing there because, in fact, they give to what? They donate back to the state. So such company, I can invest there. If they are not paying me, it's okay. You are giving it to the society, back to society. It's okay. I'll be get it. Good. But all of these will not be accounted for on the financial statements. So that means the ratio that we are going to use also lacks what? This feature. That is it. So we are done with the limitations. Now we will go into detail again when we start the actual ratios. We will break these limitations into two, specific ones and a general. I'll do that in the later periods. Now let's see. I'm going to start the actual interpretation, the actual ratio itself. Now tell me, You have two friends. Let me draw them for you. Yes. Select two of your friends. Bias one. I'm going to draw them on the board. Yes. I have two friends. Yes, I'll draw them. Even if you don't have car, I'll impose them on you. One is like this. Hey. Child. Hey. Today be today. Okay. Here's a hand then. Hey. Okay. So that's okay. And this is your good friend A and your friend B. Have you seen your friend B? Good. This is your friend B. Good. This is your friend B. So tell me, which of these two friends they are very good and very bad, extremely bad and extremely good. Tell me which of your friends. So I'm waiting. Good. Okay, so tell me. So have you seen that you're not saying anything? Yes. Hmm. This one there. In fact, let's move on. You realize that you can't tell us that this your friend is very bad. This your friend is very good. No, it does not exist. So you tell me that in terms of walking, that my friend is very good at walking. No. In terms of gossiping, hi, that my friend dear. Hey. But in terms of advice, comfort, being there, that my friend is very good. In terms of head, A is far, far, far better than B. Oh. Have you seen? In terms of eye, this one is far, far, far better than. In terms of fatness, see that this one is like it's like obolo. This is obolo. You can even see. But this one there, one line, right? Yes, like that. This one, the arms are very short. So the arms are very long, it's even getting to the ground. Like this one to the same thing. That is it. So the same way we bring it to ratio, you can't tell us that there's a one particular company who is the best company on this set. Never. So as a result of that, we have grouped the organization's activity. Okay, in terms of hand, you are doing well, you are good. But when it comes to head, dear child, child. When it comes to walking, dear, do well. But when it comes to running, child. The same way when it comes to running, you can do well. But when it comes to just walking, small now you are tired. Yes. When I ask you to run, you can run. But for walking there, you can't do it. You want everything to be fast, fast. Obviously, walking will not be fast. Good. That is it. So it means that it's very difficult to tell that this company there you are the best though, because if care is not taken and going to say that this company is the best, the next day to collapse, you be in trouble. Even auditors, when they are forming the audit opinion card, they are careful. Yes, Well, they'll tell that, oh, this company there, the accounts are clean, everything is okay. The next day, now they collapse. So have they been audited? So that is it. So as a result of that, we have grouped the organization's activity into 5 in terms of making profits. Some of the company they are very superb. So you have what you call profitability. So you have profitability ratios. Yes, in terms of profitability, some of the company they are very good in terms of making profit. When it comes to liquidity, like they've sacrificed all their money away. So liquidity. So you group them into what? Liquidity. Then what about efficiency? Some of the organization too, for them, what support them is their efficiency level. They are being efficient. Yes, have you seen? If you go to some kitchen, yes, they can just use few ingredients to prepare a very delicious what meal. But some kitchen to give everything double, 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 double. If it not be nice, not be nice. So that's the efficiency I'm talking about here. Efficiency. Good. So some people they have little item, but the way they can manage it is there. Your plenty item get finished. Still, the little one is still there. Yes. A company like this, your revenue is let's say 100 Ghana. And company like this, your revenue is just 110. Oh, who is doing well? Of all these big assets that you have, the big trucks that you have, the store building that you have, the big office space that you have, nicest rooms that you have, the money that you have is this. Child, me that I don't have all the facilities, you can generate this. Okay, that's efficiency. Good. Now let's move on with the game. There are 5. Then we go to gearing, gearing or solvency. So gearing slash solvency. Some company they are very good in terms of manipulating or taking debt. Hey, they come right now in a different mouth. Tomorrow they are here with a different story. We need money to go and buy this. Tomorrow, different item. Gearing. Good. So in terms of gearing, who is the best? Or are you doing well in terms of what? Debt. Gearing talks about debt. So I'll explain that. Then finally, investor or market position. Market position. Wow, I like that. So upon all the huge profit that you are declaring, the large cash flows, you are being efficient. What's your market position? So in the market, the your share price, your earnings per share, all of them they burn down. Hi, thank you. So in the industry, so the in that let's say if you are with the pharmacy industry, so all the companies there, what is your market share, your market position, your earnings per share? Try. So that is it. So you cannot tell that this company is the best, this company is doing well. As a result of that, you have to use this section. These are the key ratios. These are what you are going to talk about. And then you are fine. Okay, so now let's go into the game. We are going to talk about each of them into what detail and see These are the key ratios. They are the key ratios. We are going to talk about them. And then there are ratios under each that we are going to talk about. Please, for ratio, all what you need to know is one, how to calculate the formula. Two, the interpretation. Three, you are done submitting yourself for the exams. That's all. So one, know the formula and then how to calculate it. Two, the interpretation. For now, we are just going to learn the formulas, familiar ourselves with how we can calculate some of the ratios, and then that's the end of the game. After the calculation, all of them, then we start with the interpretation. How are you going to assess the performance of the organization? So that is it. Now, when they ask you the importance of ratio or the use of ratio, and you are stuck, you don't have any point. These are the importance of ratio. 5 critical importance of ratio. One, help us to assess profitability, liquidity, efficiency, solvency, and market position of a company. This is a company. So let me put the company here. Yes. To help us to assess profitability of the company, liquidity of the company, efficiency of the company, solvency of the company, and market position of the company. That is it. That's important, or the use of ratio analysis. Anywhere they ask you and you are stuck, don't have any point. I mean, we talk about the main important and realize that the main important, some of these factors are inside. First, you look at performance. Second, profitability is there. Third, liquidity is here. Fourth, you said that operational efficiency. So here. We talk about risks. Financial risk is here. This financial risk. We talk about investments, right? For decision making, this is a market position. That means basically what you talk about there, that's what you provided here. How we get it? Good. My critical point is the limitations, though. These are limitations. Now let's continue the game. The game is getting interesting. The game is getting. Now you're going to pick each of the key ratios, the 5 key ratios, and talk about them and give the breakdown. Each of them is like a family, like a key classification of the ratios. So when I pick something like profitability, so let's write here the key ratios. Keyword ratios. The 5 key ratios. First, number 1, profitability. If we talk about profitability ratios, I'll add ratios to it too. Profitability ratios. We also call operating profits, operating performance. But this ratio is here, so let me take it off and add more stuff to it. It's also called operating performance. So when I ask you to assess the operating performance, I am just talking about profitability ratios. Okay. The first ratio on the list is, but before that, let's explain profitability ratio. Profitability ratio. So this one is a group of ratios, or is a ratio that assess the profitability of organization, the ability of the organization to generate enough what? Revenue. Enough revenue for 8 operations. So enough revenue, enough profit for the operations. Enough revenue and enough what? Profit. That is the profitability ratio. That is the profitability ratio. Yes. So it assesses how strong in terms of generating what? Revenue and what? Profit. Good. Because sometimes long-term survival depend on your profit. Some companies, they are no more. Because probably they were making consistent losses. So got a time they have to vanish from. And let's ask this question. Let's assume you're making consistent losses. Consistency to the extent that your retained earning is negative. But you have a good cash position. Will you quit business or you continue? You are making consistent losses. But your cash, in terms of cash, you are doing well. In terms of cash there, yes. Don't give your cash chance. So you're taking them. So look it. That is it. Now it's a trial. Now let's look at the ratios under the profitability. First, I'm going to talk about gross profit margin. Gross profit margin. We'll look at the formulas together. So today is a formula work. Gross profit margin. Gross profit margin. Gross profit margin. Okay. B, we are going to look at operating profit margin. Operating profit margin. And then third ratio, as the name suggests, net profit margin. Then we will talk about almighty ROCE. ROCE, because it return on capital that you have employed. I think that will be for today's section. Return on capital that you have employed. What's the return? So the money that you are using to make or run the business, what's the return? D, the next one, there's a second section of the return on capital employed. This one is called ROCE. ROCE, or the ROI. We call it return on shareholders fund or equity. Return on equity or return on shareholders fund. Sorry, that side is not coming. Good. Return on equity or return on shareholders fund. Shareholders fund. Shareholders fund. That is it. That is the ROI. So these are the profitability ratios. So these are the ratios that are going to use to assess the operating performance of the entity. Good. So first, you should know the formulas of all this. Good. In fact, we have the margins and then the returns. Three margins, margin. Then we have what? The two returns. Good. They form part. So the margin it talks about your ability to generate the what? The profit. And then returns. How much are you giving to the owners? Those that brought the money. Yes. So how much is their return? That's all. Good. Now I'm going to look at the formulas and then we start some few calculation. Good. So now we are just looking at the formulas and how to calculate it. That's all. The rest we do it later. That one is interpretation. Another day. Good. Okay. Now, anything margin is that item over sales times 100. Anything margin, because margin simple means a profit expressed as a percentage of sales. So that is it. Anything margin is that item over sales times 100. So AMA margin, AMA over sales times 100. Coffee margin, coffee over sales times 100. Who again? Yeah, okay. Yeah margin, yeah over sales times 100. You are done. Enoch, Enoch margin, Enoch over sales times 100. C over sales times 100. You are done. So gross profit margin to be, who tell us? Gross profit margin to be, if I write the formula well, it's nothing but the gross profit over sales times what? 100. So that's the formula. Gross profit, GP, no shortcut. Gross profit over sales times what? 100. What about operating profit margin? Let me see. Operating profit margin, what will be the formula? Anything margin is that item over sales times 100. What about operating profit margin? Great. Operating profit over sales times 100. By which of the operating profit? Here we are interested in the profit before interest and tax. We are interested in profit before interest and tax. I'll bring these guys back again. So I want to take them and write the formula boldly. You are writing small there. I don't like it because they are what? Hints. Formulas are like great. So I'll take this section, then I'll bring it back as and when the need arise. So that I can write them boldly here. Gross profit margin is nothing by your gross profit. Your gross profit divided by what? Sales revenue times what? 100. That's it. Anything margin is that item over sales times 100. That's all. So you can calculate your margin, your name margin. You pick your name, divide it by sales times 100. Anything margin, okay. The margin of fund. Yes. The next one is operating profit margin. That's B. Operating profit margin. As usual, but here the operating profit that we are interested is the profit before interest and tax. So it's the profit before interest and tax, PBIT, all divided by sales times 100. Oh. But it's not as that we said that anything margin is that item over sales times 100. But here they are changing our mind. No, we've not changed our mind. It's still the same. The operating profit that we are interested in is the one before interest and tax. Yes, the one that we are interested. It's also operating profit. But that's the actual operating profit. The operating profit. Good. And I hope you know how to calculate operating profit. You know two ways. The normal way and plus the cash flow method. With the cash flow, we pick the profit before tax, we add back the finance cost, we add the profit before interest and tax. Good. And your examiner is fully aware that you've done cash flow too. So he can manipulate and then be moving as left, then right. Like that. Okay. Now let's move on. What about net profit margin? Net profit margin. Net profit margin, that's the C, right? Anything, so it's the net profit, right? Which is same as what? Antipart, Good. Profit after tax, all divided by what? Sales times what? 100. Anything margin is that item over sales times 100. However, there was an aspect that I have to let you know. That aspect is the markup. You have margin and markup. So if they say markup, that one is over cost of sales. So anything markup is that item over what? Cost of sales, because markup simple means profit expressed as a percentage of cost. So if they say markup, that one is that item over what? Cost of sales. Markup is on cost. So markup is that item over the cost, and the cost is what? Cost of sales times 100. But please, we are interested in the margins as compared to the markup though. We won't, for ratios, we've not asked for markup before, but it's an awareness that we are sounding. So it's possible they can ask. So now let's move on. We are done with the margins and the markups, right? Margins and markups. Let's go to the returns. Let's go to the returns. The returns. ROCE, return on capital that you have employed. So capital employed. Good. Capital employed. Return on capital employed. Now, when you mention capital employed, there are two things. Let's do some small exercise here. Let's assume that you want to establish business. That business, you need, let's say, any example. Let's use 10,000. 10,000 is the money that you are looking for to set up your business. Well, okay, it's 10,000. But it's too small. Let's make it 100,000 here. Okay. This 100,000 are looking to start your business, your dream business. How are you going to raise this money? How are you going to raise this money? Okay, so we have two sections. Either you raise part through equity and what? Debt, go for loan. So someone's okay, mid-tier, I'm afraid of debt. So equity 80,000, debt 20,000. When I come, I can take part of the equity and give it to them so they run away. Okay. So therefore, the capital that you have employed is what? 100,000, which is made up of what? Equity, the one provided by the owner, your personal money that you paid in, plus what other people gave you. All together, that's the total capital that you are looking for. Because sometimes it's not possible to raise all the funds that you need by yourself. It will not happen. And that we don't have big organizations. Sometimes the capital that required goes beyond one person's ability. Consider mining firms. Consider airplane, car manufacturers. The capital required. Good. So that is it. So consider all this. So the capital that you have employed, but don't forget that all these people, they are not giving the money for free, including yourself. Oh. Are you giving that money to set? Are you setting that business for free? Won't you take something from it? Yes, you take. Probably take something. That's your return. You know. Just that the return on equity is the dividend, right? And the return on debt is the interest that you are paying to the debt holders. Have you seen? There's nothing for free, oh, including government interest-free loan. That's also for free. So there's nothing for free. So even you yourself, like you are forming a business, but you have a purpose, right? And how come the bank who is giving you the loan? You, the owner of the business, you want a return. The same way the bank also giving you the loan to also have a want return. So that is it. So this return, so it means that we have the returns which is going for all of these two people, and then the returns only solely for what? The equity holders. So basically that is it. So if I want to calculate the return that I'm getting, or the return that on the capital that I've employed. Now we know that the capital that I've employed is what? Equity plus debt. Great. Long-term debt, non-current liability. The debt is a non-current liability. And yet to examiner is aware that when it comes to non-current liability, in fact, you are superb. So it can be moving you alongside. Good. So that is it. Okay. So it will be calculated as follows. Let's assume that the whole year you've made a profit of, let's say, profit of 200. So it must be shared by these people and these people. But the owner will not take all of them alone. Go and give some to the debt holder. So, in short, the formula is this. All what I want to illustrate is this. When we mention capital employed, it's made up of equity and what? Debt. Sometimes too, you can also say that, okay, me, I don't want any debt in my life. I raise all the 100,000 by myself. I don't want trouble. Yes. Done. Or sometimes too, yes, I'll play a smart game. Raise all the funds by debt, right? All the 100,000 by debt. So that when there's something happen, run fast to a competent court, let them declare you bankrupt. It solved the matter. How we get it? Good. So that is it. Okay, so in short, proceed is return on capital that you have employed. And the capital, there are two forms, equity and debt. So it's nothing by the profit which is available to pay equity holders and what? Debt holders. So what's that profit? There's a particular profit on our profit and loss account. It is available to pay what? The debt and then the equity holders. What type of profit is that? Who can tell us? So that profit is called profit before interest and tax. This profit is before interest. The interest is what? The debt holders, their return. So you are going to pick profit which is available for these two people. There are two guys all together, yourself, the business owner, and the debt holders, the other financiers. So what is the profit available for you guys? Okay. Now for debt holders, their return is the interest. What about the equity holders, the owners? They will take everything. So they take the profit after tax. So that is it. So profit before interest and tax all over equity plus non-current liability, which we can call it what? Capital employed. That's all. So this is the capital employed. This is called capital employed. And you have explained it here, the source of the capital employed. It can also be calculated as what? Net asset. Capital employed can also be calculated as what? Net total asset. Net total asset. So net total asset or total net asset, which is the total asset less current liability. That's it. So equity plus non-current liability is also the same as what? Total asset less current liability. Okay, that is it. Now let's move on to that of return on equity, the ROI, or return on shareholders fund. Okay, let's go to the next one. For this one times 100 though. All the returns times 100. The last one I'm going to look out for is return on equity. So return on what? Equity. This one is only equity holder, the owner. Or return on shareholders fund. Shareholders fund. Please, this return, it's only to who? The equity holders. No debt holders. They are not part. Debt holders are not part, only equity holders. What will be the formula? So what is the profit available to pay equity holders? Equity holders, they take the last profit, right? Whatever remain, we give it to them. So then we take the anti-part. Profit. Thank you. So profit after tax, all divided by what? Equity. Only equity, no debt. Times what? 100. And that is it. Great. So you are going to back it with what? Illustration. Just that in the calculation of the ratios, this is how we want it. You'll be provided sometimes or usually with two or more calculations. So either you're going to make this um, style number one, we will call it trend analysis. Trend analysis. Style number two, intercompany comparison. So they'll give you that 2018 versus 2017 versus 2016. Two, 2 years is okay. So from two, three, four going in that order, as many as possible. Good. Then intercompany comparison. So intercompany. So company A versus company B or versus company C, three companies or two companies. All of them, they can come with the industrial average or sector averages. That one is optional. Industrial averages are optional. So, so that is the ratio. So in any of these, when you're going to calculate like the one you're going to do right now, this is how you want it to be. So line, that's not part of the budget. Going, going. Okay. When it starts, the calculation of the ratio. So say calculation of the ratios. Put them in a nice table, even if they are 1,000 years. Column. Don't do this year, then come and do the next year. There will not be space and time for it. So it starts. The name of the ratio will be here. The formula will come. If there are 2 years, this is it. If there are two companies, that is it. So the name of the ratio, the formula, the nice table. If you are calculating for 2018 and 2017, you are done. Or if it is for two companies, you are calculating for June Limited and July. Good. Let me do company A and company B. No trouble. No trouble. Company A and company D. That is it. So this is how we want it. Then you start. Maybe gross profit margin. Tell the examiner that is the gross profit over sales, everything times what? 100. You put it down. You go look for the gross profit for the company A or the current year, their sales, the same for B, and then everything like that. You leave a space, write the answer in here, you are done. And you can line it nicely. You come to the next ratio. Operating profit margin. Tell us the formula, profit before interest and tax, all over sales, times 100. Look for A, look for B, write the answer down, you are done. Move on to the next one until you are done. Do not write A like this and calculate all the ratios. When you're done, come and do B, you calculate all the ratios. No. It will be waste of time. Okay, so we are going to back it with what illustration. I'll project some question, and then as soon as they are in, you try. We're only calculating the profitability ratio, the five profitability ratio that we look at it. We're doing all this. Okay, so let's see. Let's one nice question for us to look at it. Okay, so let's see for the game. Okay, so let me see. Obia, right? This is Obia. Hmm. Okay. So Obia. Uh, okay, let's look at okay, Obia has been solved successfully. Wow, that's fine. Then who again? Fadama. Fadama is question 2. Fadama. No, we won't solve Fadama. Diamond and shine, no. Diamond and shine, no. Zangi. Zangi Limited. Yep. Zangi Limited. Wow. The one that's not plenty. Okay, this one is who? Is it Peace? So Wood Bank. Okay, Wood Bank. Want to have solution. Wood Bank. Then who again? This one is what? Quarter. Want to have solution. Quarter. And Peace Limited, right? This is Peace Limited. I like that. Peace. The question to have peace. Okay, so you are doing Peace Limited. Just the profitability. Just the profitability. Peace Limited. Okay. Peace Limited. Okay, that is page 26. Peace Limited. You are just calculating the profitability ratios. Anywhere you want me to move, I'll move. Okay, there's an issue here. I want the one that we can move fast, so it's our time. Oh, you try. Have you seen? You try. Okay. Okay, so you will try Peace for me. Yes, Peace Limited. You are doing Peace Limited. Yes. Solution would be something like this. So 2012 might be here. 2011 must also be here. Go to the question. What 2012 gross profits is 161,500. The figures are too big. Oh. It's part of the game. Oh. 161,500. So 161,500 all divided by the sales. So what is the sales? Sales is 456,500. 456,000 times 100. Then I will leave a line. Come and write the answer here. Listen. So here, the answer happened to be So 35.42%, right? Then I'll go to 2011. In fact, I'll even do the substitution for all of them before start the actual work. So for 2011 to gross profit is 193,420. So 193,000 and 420,000 times 100%. And that one is 46%, right? Okay, or 45.95, eh? No, it's 95%. Great. So this is how the answer should be. All of them should be on the same line. Now listen, the same line. Great. Then I'll go to this profit before interest and tax. So that one pick the profit. Okay. Okay. Good. So the profit before interest and tax. You pick the profit before tax of 42, you add the 14,500 to it. So 42,000 plus 14,500. It was 42,500 plus 14,500. Also divided by sales, so 45,65000 times 100. You put the answer here. Do the same thing for this. Put the answer there in that order. That's how we want it. So great. So that is it.